Greetings, everybody. It is a little bit after 11 on Saturday night, the 30th of 2019. And by the time you see this, it will be the 31st, hence the date, the last date of March, and also the last date of the first quarter. Using a different rig tonight, there might be a little bit of echo here. I had some mic issues. I titled today with a question saying time for the next leg up, and I'll try and show you the information that support that. As always, it's for education purposes only. Any recommendation in the spirit of education, not investment advice. For those who haven't been here before, I'm a doctor. I've been trading for 30 years. I joke about most physicians lose money with their investments. Actually, most of the physicians that I used to practice with, we'd sit in the dining room, trade tips, and that was not a way to make money. I'm independent. I pay for the tools that I have. I have a customized version of HGSI, and working with George to potentially put out a add-on that would be potentially a paid add-on, which will be different, and looking at partnering with certain gurus out there to bring some different capabilities to HGSI. So if mine looks different from you, it's because it's something that I'm developing with George. And trading involved risk, and you alone are solely responsible for any decisions that you make. I always like to call out where my style came from. I started with canceling from O'Neill, improved by Morales and Catcher, taken to the computer with HGSI, heart and soul of the concept, not the technology, was Ian. George Roberts is the technology. Ron Brown used to sit in the audience with me, and then he became Ian's partner. We both use HGSI, but we use it very differently. Those that follow him know he's a very big proponent of volume spread analysis. George Lee, a great trader from the Pacific Northwest, who a couple times a year I'll share the podium with at live programs. Van Tharp, the king of position size and money management. Superior Profit, I actually had the opportunity a week ago to have dinner with Cigar in Thailand. What a great guy, great technology tools. Not a replacement for HGSI, requires a data source from Metastock, so it's on his top-down tool. But he has some indicators and tools that I use every day and find to be a very useful adjunct to what I do. And then the person that really changed my trading and my outcomes was John Person. His indicators, his books, his live education. Then he taught me how to play golf and became my friend. So I don't think that playing golf has helped my trading, but it's certainly been entertaining, to put it mildly. I have lots of tools. I need TradeStation and Thinkorswim, and specifically all the indicators that I purchased to use with them. I use HGSI and EdgeRater every day. I use Cigar Superior Profit tools. There's an online program called TacticalTrader.com that I'm going to try and put some of my stuff in as well. The rest are supportive. I am independent of HGSI, but here's their website, and I call out that it's a free 30-day trial. And under investing strategies, you'll see hundreds of videos by myself, Ron Brown, and others. It's really a community of folks that help each other. There are no big names that are associated with HGSI, no big egos, just a lot of folks. Docs. I'm one of the docs. But a lot of folks who are committed to helping others, and a great website, great online a board, a Yahoo group. I guess it's still a Yahoo group. Plus, my Discord site supports it as well. Now, I care a lot about where we are in the cycle. The last week or so, I thought we were rolling over. I said that every time it looks like it's rolling over, it turns around. We pulled into support, especially on the intraday time frames, and we bounced. And it almost feels like we're in the midst of another leg up. If you think about seasonality, April is a strong month. May is when the market starts to turn the other way. Sell in May and go away. So maybe we're going to run up before the end of the month, or during this month, before we get into May. So I started going more aggressive on buying stocks and calls and started covering my short positions. If you look at how Friday ended, green is good and red is bad. In real estate And utilities, where's the utilities at? Real estate here by far was the weakest. I hope I didn't nail the utility. Here's the utilities. Utilities weren't that bad, but a very strong day. Energy was weak as well on Friday. But compared to a Friday a week ago, a sea of green. Now, the major markets, if I look at them, we could see that we're in uptrends. This is the E-minis. This is the NASDAQ. This is the Dow futures. This is the Russell ETF, IWM, the VIX, and the dollar. So I like to look at these, and what I see is the market's had a big V bottom, straight up. Now, you don't see it on the futures, but on the cash markets, on the E-minis and the YMs, on Thinkorswim, there was a new buy signal. We're above the green, which is the 50-day moving average, the 17-day moving average on all three of those. The best performance in the fourth quarter was the NASDAQ. Second best was the Russell, even though the Russell's further down in the pattern. If you look at over the last 3 months, percentage-wise, it had a big move. The VIX is down in complacency land, and the dollar is struggling to break out. It's been in a trading range for months. If I look at the weeklies, you can get that sense that the last couple of weeks we've been bouncing around. Take a look at the Dow futures here. But we closed on a high note. We ended the quarter strong, and I'll talk more about that as we go forward. Now, sometimes I'll look at my Genesis charts. Now, the signal calculation, when I say buy and sell on these charts, it's John Person's PPS buy and sell. Although conceptually they're the same across platforms, John likes to point out that there are some minor differences in the calculations based upon the capabilities. So on the top are daily, the middle are weekly, the bottom are monthly. First column's E-minis, then the NASDAQ futures, then the Russell futures. Then you got the NYSE, which is a cash market, and the Dow. Notice that on the E-minis, the NASDAQ, the NYSE, and on the Dow futures all signaled a new daily buy signal on Friday. Notice down here, everything has a new monthly buy signal. When long-term signals start to turn positive, that probably tells you something from a larger perspective. Now, of course, because of the chop we're in, we're still in weekly sell signals, at least on the Russell, the NYSE, and the Dow. So this is kind of interesting, the new daily signals and the new monthly signals. Now, what's underneath this market? Well, the rates continue to drift down. Interesting arguments this week. Kudlow saying no inflation, not overheated economy, cut 50 basis points and stimulate the economy. That came out of the White House. And at the same time, you had a Fed head coming on saying maybe they need to raise rates. So it'll be interesting to see what happens. Clearly, falling rates are good for REITs, MLPs, utilities, dividend payers, and home builders. Now, you can't see it well here, but this blue line shows that the inversion of the 2s and 10s continues to get, flattening of the yield curve and getting close to that inversion point. When I look over long term, it's not the inversion that kills the market. It's the economy that probably follows it that slows down, and maybe the inversion is more a signal of that. And it's when the Fed starts cutting rates to stimulate the economy that the market starts falling. So right now, I don't expect this to pull the market down. It's when the spread starts to increase and the inversion reverses is typically when the market starts to sell off. AD lines, here's a Russell 2000, small stocks on the left, big stocks on the right. But let's just take a look at the NYSE. We're broke out to new highs on Friday. So the major market ETFs, the diamonds, Qs, spiders, IWM, and transports all turned up, lagging the AD line, but all going north. And notice with the weakness in rates, bonds continue to go higher. What about breadth? Stocks above the 200 days, stocks above the 40 days, and 3-week new high, new lows all improved this week. Not quite into overbought bought areas, but demonstration of improving breadth. The daily McClellan, I don't see a zero-line reject. I don't see any clear-cut divergences. So I don't see a signal on the McClellan. You're going up here, heading down on the summation index, but you're actually starting to go flatline. So I'm not sure that that's a signal. So underneath so far looks okay. The buckets have gone to neutral. They were decidedly negative a week ago, which is why I said within a day or two or three I expected a reversal. You can see now very few stocks are below their lower Bollinger Band. There is no evidence of a Hindenburg omen on either the NYSE or the NASDAQ. Not a surprise. We probably have to go out to new highs and get a little extended before we see them. Market tone, which was very strong for a couple of months, weakened. Notice there's no more red down here, and this is the Woody indicator. Green is a buy, yellow is neutral, red is a sell. So it's improved, as has overall sector strength. With compared to a week ago, we've got more green and less red. Canaries in the coal mine, those big stocks that used to be leaders, they're not leaders anymore. And I think one take-home message here is just because you led last year doesn't mean you're going to lead this year. This index is range-bound between the 200 and the 50. It's going nowhere. I will call out that Amazon and Google both have monthly buy signals on person indicators. And looking at seasonality, if I get to it on Amazon, it's strong. So maybe it's a time to think about Amazon. This is the index I put together at the beginning of March to give me a signal of when this market was going to roll over. It is pulled back, but frankly, it's just under the 8 and 17-day moving averages. This is with a couple negative kahunas and what has been a weak market. That said, the volume has been low on this pullback. I'm looking for this to resume its uptrend if the market is strong. For those that are new to what we do, this is something that Ian taught us, which is why I still call it E-index, that if at market tops, take a look at the leading stocks. And when the leading stocks roll over, it's a signal that the market's done. I don't think we've rolled over yet. There's certainly a shot across the bow, but I'm not sure that they're done going up. Notice how the market top in September, October was called by days and days of Hindenburg omen signals. Those things work, and notice we haven't had one on the right side of the chart. Know your news and earnings, so I haven't looked closely at this. I mean, anytime you got the monthly unemployment report on Friday, you've got a busy news week. Jobless claims on Thursday. Petroleum numbers always come out on Wednesday, some on Tuesday night as well. Durable goods, retail sales. Doesn't look like we have a lot of talking heads. We got a couple talking heads during the week. Again, busy news week because of the monthly unemployment report. Not much on the earnings front. I didn't say nothing on the earnings front. I said not much. And if you own any of these stocks, it's a big earnings week for you. If you follow Twitter, just search Earnings Whispers, and you can get every day. Earnings Whispers will put out a picture like this of what's coming before and after the market. They'll give you some charts and give you some data to help you in your decision making. As I say in the lower right-hand corner, it's a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock earnings date is scheduled. So, what are my thoughts? Markets cap a strong first quarter with a positive week. You'll see I'm up in over 50% when I combine my accounts. I was up a little higher. Frankly, I moved up very quickly in January and treaded water the next 2 months. I start all over for the quarter on Monday, so let's see what I can do in the second quarter, which means I was 3 times the NASDAQ. So I'm very happy with my performance. You could see here that all the major indices were up double digits. As I mentioned, at least intraday support held on the latest pullback with new buy signals both on short and long term. Chart signals and strong seasonality suggest a strong run into May when the sell in May and go away kicks in. And that said, the Chinese talks, the Mueller report revealed to Congress and the public, and Fed speak may ultimately determine where the market goes. and I did increase on Friday my long exposure. We'll do our typical top-down agenda, and now let's go and look at some charts. So for those who weren't paying attention to my travels, I replaced my boat as my background. This is a picture from Long Bay, and this was just, unfortunately, it was not sunny, so we could see the emerald water and the lush greens on the rocks. But there's something cool, I think, with the fog and the almost gray, black and white and gray color scheme. This is from my trip. We're home, so no more pictures of Sherry and I, which you're probably relieved of. I always like to look at where the indexes are. Let's start with the E-minis. This is TradeStation version 10, and I'm using on it John Person's lifetime VIP package, which generates signals. Alexander Elder has a package which I use. The bongos from HGSI I coded into TradeStation. The high jump from HGSI I coded into TradeStation, and then I compare the current score with the last, in this case, 200 bars, and give you an idea of what percent you are to the highest high, and knowing when it gets above 95 that we usually see a reversal. So E-minis. And I don't know why I have a hard time displaying. There was a buy signal down here. Let me see if I can make it come up. There it is. You can see it's hiding down there. That's the weekly. There you go. So we got a daily, weekly, and monthly buy signal on the E-minis. Green bar means I can be going long. It's an Alexander Impulse indicator or holding. I should not be going short. Blue on the weekly, green on the monthly. I'm in the middle of the auto envelope. I don't see any fresh dots here above or below, which are MACD divergence or convergence. My weekly bongo is green, which is good. I'm at 87%. I can certainly go higher. The E-mini looks strong. Doesn't it look like it wants to go higher from here? The Dow futures, daily and monthly are long, even with the green bar, but the weekly is still short, sort of what I showed you on the Genesis picture. 83% daily and weekly bongo are green. That looks like it wants to go higher. The NASDAQ, and again, I told you there was a buy signal. The buy signal is hiding under there. The NASDAQ is in a weekly and monthly buy. It's got a green bar here, but notice it's still in a daily sell. That's something that can reverse probably on Monday if the market is strong. 83% weekly bongo still green. If I had to predict a direction despite it being in a daily sell, I think it goes higher here. The Russell futures turned positive on TradeStation on Thursday, still on the weekly are negative, and on the monthly they're in a buy signal, 68%. If we look at the dollar, which has been strong, you can see it's had a big run since this buy signal came in. It's at a buy signal in all three time frames, but only at 51%, so it could still go higher. The fact it's up near that upper envelope, you could see it can track this for days, but typically when it gets there, there's ultimately a pullback. When you get it down here, there's also a reversion to the mean from there as well. So that gives me a sense that this market is probably strong. Next, I open up the designer. I go to the market analyst groups, which are something that Ron Brown supplies. Now, the industries seem to have dropped off his group, so I actually bring this in from a prior edition. You could certainly go up and use the industry groups that are in the reference as well. But let's start with Major Markets Plus. Let's hit Warehouse. And let's hit Top-Down View. Make sure by raw combo, this is looking at 1 day performance, the most, 5 days, the middle, and just a little bit on 2 or 3 weeks with the force. And let's see what ETFs, commodities, etc. came to the top. When I see the Dow, the NASDAQ, the transports, the mid-caps, biotech, NYSE, all up at the top, I know it was a strong week for equities. Unfortunately, I had a restoration hardware position, small position compared to my normal size. And I was glad because I wiped out my options, which cost me I had a spread, a bull call spread, and I had $8 in each in my calls. The stock dropped a lot more than $8. That's the benefit of options. What goes against you with the options is the stock ever recovers in 5 months, well, my options will be long gone by that time because of the timepiece. So let's take a look at S&P 500. We'll start with that. And let's go into the indice view. All right. And all right. So you can, actually, let's just go to a view that you've seen. No, I want to leave this view. V bottom moving up. This is my trailing stop in green. You could see right here we had a buy signal on Friday. You could see it down here as well. We had some phoenixes over the last couple of weeks in the market. Phoenix came in on the hard sell-off at the beginning of the week. Sometimes they are a one-day wonder, and sometimes they show a market that's turning around, especially a market that's extended. I'm going to consider that a one-day wonder. We're in a squeeze here. Bongos are green. Looks like it wants to go higher to me. Does it go straight to the moon, or does it backfill a little bit and go sideways and move up slowly? I think it's more likely going to do something like this, not a right angle. This was a pretty phenomenal move up. This is probably much more of a sustainable move. This was a little bit fast. Just to give you an idea of how fast. This is one of the things I like about HGSI. So easy to do things. Go from the low here to where we are right now. We had a 21% move in 64 days. If I look from here, just from down here up to the high, we had a 15% move in 121 days. So really more than twice the velocity here. You don't expect that to continue. S&P looks like it's going to go higher. The Dow Jones Industrial Average looks a lot like the S&P. New buy signal came in on Thursday, kahuna on Friday. Looks like it wants to go higher. The NASDAQ. Yeah, I know it's right in front of me. That's the worst place to hide something. Pull back into support, moved up here on Friday, closed at the high of the day. It wants to go higher. The Russell 2000, weaker than the others, and you could see it's below its chandelier stop, which will be a new feature in an upcoming update of HGSI. Did have a buy signal on Thursday, was up on Friday. But that said, it's the weakest of the bunch, but still looks like it wants to go higher. I just want to go back to the S&P for a second. Yeah. All right. The dollar broke out some on Friday. It's really kind of gone sideways for 4 months. A breakout to the upside, probably not great for equities, certainly not good for commodities. If we look at the VIX down on the bottom here, because the VIX is at a point where it's been dropping over the last year at periods of low volatility in the market. Strong dollar, you can kind of predict what's going to happen with gold. Gold has dropped the last couple of days, is now below its chandelier. If I look at silver, even worse. All right. And lastly, let's look at oil, which has been strong and continues to move up nicely. It's going to get some resistance likely up here at the 200-day trend line, which is still dropping. So I feel good about the market, at least in the short term, until Monday morning at 9:31 when all bets are off. I have 174 industry groups. I have to find a way of ranking them. What I've been doing now is using a force, but adding a trend determinant, the JAS trend. So what this is telling me is it's including in the combo rank here, or it's supposed to be including in the combo rank, a component looking at how many of the index have a, actually I can change this now, so let's play with this for a second. We have a new, I'll show you what I'm going to do here. The basic force was a 2-day force. I can now add, let's look at the JAS. How about percentage of the index that are in a buy signal? That's good. I would like that descending, and I'm going to put a high weight. So those indexes that have a lot of stocks that are in a buy signal, I'm going to give extra weight to. How about, same thought process, those that converted today? That would be, this would be today, and let's put a lot of weight on that one. So what I'm going to do here is I'm going to rank them by force index and give extra power if they have a lot of buy signals, and even more power if they picked up a lot of buy signals today. So biotech is up at the top. Let me make sure about that. Yep. So let's right click on biotech, change the index group, and let's see if we got anything interesting here. And I want to show you a little bit of what I put into this chart. And hopefully before too long, I'll give you an opportunity to have this chart. So I added a box here. This tells me last signal. So what's the current signal on the chart? Buy or sell? So that's on the industry group. So that tells me 68% of biotech are in a buy. And then on Friday, I had 41 buys and 6 sells. And this is telling me if on the instrument there's either a weekly or daily high close doji. I have a buy signal here, duplicated it down here. I have a pocket pivot, a kahuna, a mobile breakout from a squeeze, and a viable gap up. On first glance, as I look at Celgene, I see earnings are accelerating, a very positive looking chart with the breakout, but I won't touch it because this is more of an arbitrage play. And right now the big driver is whether or not they get bought out by Bristol Myers or not. And I think there were some investor advisory groups that came out and said to approve the merger on Friday, and hence a big pop. I think it drove a lot of the market, frankly. Don't know Galapagos, no earnings, although it does have some revenue, so that might be in revenue growth, so it might be worth looking at. It had a Bible gap up on Friday, so I always can right-click more info from web and go look at FinViz and see what it tells me about Galapagos Pharmaceuticals. All right, so they have a partner with Gilead on a new drug, positive trial. Now, big market rheumatoid arthritis, you wonder if a company like this will get bought if they get the drug approved, probably bought by Gilead instead of sharing. $6 billion market cap. So obviously for a stock that has, at best, if you multiply that by 4, $500 million a year, that's 12 times sales. That's a pretty steep valuation, but something to keep an eye on. Viking Therapeutics, this one has an interesting chart. It's clearly basing here. It had a buy signal on Thursday, a kahuna on Friday, a mobile breakout from a squeeze. It switched its bongos. Let me just see one thing. Let me shift the chart a little bit to the left. I may find a different place for this because I don't really want to give up that much of my chart. Okay. So maybe it's just going to continue going sideways, but this is a move up. It's the highest close going back to this drop back here. with a lot of impulse indicators firing. That's on my buy watch list. Gilead's got to find revenue. Biogen got hammered with a stop of their Alzheimer's drug. All of these popped some on Friday, as did AMZN. Blueprint pulled back to support on the 50 with a buy signal, a pocket pivot, a kahuna. Advaxis, a Bible gap up, big move up. This one has an interesting chart. This is Aniline Pharmaceuticals. If I pop this into a weekly chart, or not, there we go. Pull back to major support here on the weekly as well. It doesn't make money. It's got growing revenue. There's something going on with this company. I'm going to watch this one as well. And then we get to the biotech index. What I do every night is I take the top 10 industry groups and I do exactly the same walk I'm taking now. Specialty pharma, for disclosure, I have a significant position in Amarin. I think it's a good place to buy it again. Had a gap up here on some data that suggested that they reduce heart disease even in people who are on other lipid medications. On Friday, the Diabetic Association, or Thursday, said, or near the end of the week, that you should be taking this. New data. Here's a good buy point. You have a kahuna, a pocket pivot on Thursday, a new Jeffrey buy until I tell you what it really is on Thursday. Sitting on support. I like Amarin down here. This stock's run too much. This is the cannabis stock that I think has got an activist investor joined it to help find a way to make money, and that's caused it to have a little bit of a run. Is it Peltz? I can't remember who came on board here. They brought on an activist investor, and I'm sure I'll remember it, Nelson Peltz, to help them figure out how to monetize their company and grow their sales. Pull back here to support. I'd like to see some momentum. The group really wasn't that strong at week's end. TG Therapeutics, this is an early stage oncology company. Their market cap is less than $1 billion. This is why it becomes interesting. It's breaking out here, got above the 200-day moving average. In a strong group. They've got a number of late-stage trial drugs. Some of them are exciting, and they had some positive data. It's a flyer. It's all data dependent. It's not earnings dependent, but this is perhaps a time to be thinking about it. You had a Bible gap up in this squeeze, and kahuna came in. Animal health, don't know anything about this, but a nice lower left, upper right. Guardant, interesting company. It's a liquid biopsy molecular diagnostics company. Does not make money. We've done some work with them, so I can't own the stock. It was a very big pop in February. This was their IPO, and this was a big move even before it popped. Ran up to over $100. It's pulled back some. This is a high tight flag. This is the kind of thing that if I could trade this, and I can't because of non-disclosures, and I'm not telling you anything inside, there's a flag. Now, it's a deep flag, but if I break above this trend line, I might be interested in playing a little bit of Guardant Health. They did a recent acquisition. One of the nice things about having an expensive stock is you can buy things for cheap using your currency of your stock. Application software, who would think of be talking about BlackBerry in 2019? But BlackBerry had a big pop this week, a Bible gap up. I have a hard time buying it because of its name. Maybe they should change their name. It'll be more compelling. Now, application software has been hot, but it's really only a little bit positive on the industry groups, although it had a lot of stocks turn positive on Friday. So this is BlackBerry, Bible gap up, a mobile breakout, a Jeffrey indicator buy, and the kahuna. Salesforce has been a big leader. Right now it's sitting on the 50. This could turn out to be a good time to buy. I'd like to see the Jeffrey indicator turn positive before I went in. Twilio, similar story. Variant had a Bible gap up on Thursday, went up again on Friday, but look at the topping tail. Probably would not be chasing that. If I owned it, I'd be looking to take some profits. Notice high closed doji, one of John's signals. Here's the doji, closed above it here. So that is a true signal. Adobe, kind of sideways. Autodesk, strong stock, pulled back to support, had Jeffrey indicator turn positive on Friday into a squeeze, and a kahuna. Now, obviously, you've never heard of a Jeffrey indicator before. I have modeled this after something in the market. My hope is that I can get the person whose indicator this is to agree that he'd like to put this into HGSI. Because it's a proprietary indicator, I had to guess what was in it with George. It does match up pretty closely with the product we try to mimic, but we have no idea what's in the product because it's not shared. And my hope is to launch an add-on in support of this person and with his support in the actual indicator. But I like Autodesk, uptrend pullback. Look at the earnings per share growth coming into this stock. Definitely a turnaround play here as it did not make money and now the earnings per share are taken off. But it's not a cheap stock by any means. NetEase, kind of sideways. Looks like it's moving up here. It has to clear its PSARs. Momo just broke above its 200-day moving average here with a new buy signal. I thought this one looked interesting, but earnings are not great. Workday, another big growth stock pulling back to support and breaking out. Paycom, one of my blunders. I made a lot of money on it and got shaken out here. And what I should have been doing is buying it back. And everybody has their issues. My issue is I'm not really good at buying back things after I've been stopped out. But boy, I should have bought that stock back here. And as you look at it in hindsight, a mobile breakout, a Jeffrey indicator, pocket pivot, a kahuna, in an area where all the moving averages are coming together, so it's probably a low-risk area, and the group strength was improving. Can't capture them all. That's one I let get away. Let's see if anything here looks attractive right now. So I typically will go down the top 10 list. We'll go down a few more infrastructure software. Microsoft, not my favorite play. On these, 2/3 are buys, 15 buys on Friday versus 4 sells. Progress Software had a buyable gap up. There's ways to play buyable gap ups. I would not let the stock get, perhaps, I could say, much lower than that point there. It closed right around here. You're not giving up a lot of risk. I would have no problem buying this thing if you get it close to where it closed there. But I'd give it a little bit below its tail and probably not too much. So Progressive Software. Oracle, nice uptrend here, sitting on the 17-day mobile breakout in a squeeze. Looks kind of a V-shaped recovery just like the market did. Not ready on Splunk. ServiceNow, Kramer loves this company. I don't love its earnings per share growth. The revenue growth is strong. They are an important component of a lot of enterprise companies' software. This, Workday, Paycom, and it's an early on growth story, very high multiple. You could argue that it's a high base, a mobile breakup from a squeeze, a Jeffrey indicator, and chase it. It's not without risk because it's had a big run. Obviously, you want to be buying things down here, but they look a lot better now when you see the gap up. Palo Alto Networks is giving you a chance to buy. It hasn't pulled back to the 50, but it has come in here. Did get my indicator triggering as well as a kahuna. Internet Media. IQ, there's several stocks in this list that I like, so I'm going to spend a few minutes going down there and giving you my comments. IQ, this is one that was a darling that sold off hard with the Chinese market. Here's a chance to buy it, pull back to the support on the 50, my indicator fired. It may be early. and you got a weekly bongo that's red. But I'm going to watch that closely, especially if we can get up to this point here and clear that PSAR dot. I'll be more comfortable. Weibo made a lot of money on this in the past on its way up. It's come down to support. It's given me a couple of false breakouts and it comes right back down. Therefore, I won't touch it until it clears the 200 and closes above it, probably more than one day. But I'll still be watching it. Hoya I do own, and Hoya has broken out recently and continues to look strong. Probably not too far extended at this point. YY is another one I like, a lot like Hoya, broke above the 200, retested. New buy signals came in on Friday. And then what I want to show you on Google, let's see if it's, Google's sort of in a fry pan bottom. Maybe this is a handle forming. Google and Amazon have new buy signals on the monthly basis. That's meaningful to me, and I'm going to spend some time over the weekend seeing if I want to expand my Amazon position or is it time to dabble with a little bit of Google. Earnings per share don't look particularly attractive right here. This is top-down approach. We're looking at stocks that are being driven by industry group and looking at the best ones in the industry group. Looking now at specialty apparel. Lululemon hit a viable gap up. I have to let this settle out before I can get into it. Burlington Stores sold off, I think, on earnings, trying to work its way back, not necessarily ready. Look at this, 86% of the group are in buys. Ross Stores, see if anything here looks compelling. Here's a leader, Abercrombie & Fitch, cup, handle, breakout. Hasn't run much since the breakout. Turnaround stock coming. I've owned it in the past, under demand, pays a dividend. Not necessarily my favorite stock, but of the group so far, the one that looked the most viable, as does TJ Maxx, which is in a nice 30 degrees uptrend off the bottom. IT services coming down to, there's a couple of these I like, so let's look at these. So you notice 75% are in buys. This is Accenture, again, big V market reversal. Viable gap up on Thursday. Not that enamored with this stock. It's had a big run. It's kind of overbought, in my opinion. BZUN is another stock, Chinese stock, that I made a lot of money on the way up. Is this one coming back? I don't know. Is it getting time for me to think about nibbling? Yes. Broke above the PSAR dot. It's in a Jeffrey buy, a Kahuna, and a mobile breakout. Again, I'm just calling it Jeffrey buy so I don't say the name of what it really is because I don't have permission. And frankly, I don't really know that this is the same indicator as this other person's indicator because I don't know what's underneath that indicator, but I wanted to come up with something to model out so that we can look at it and decide if it's worthwhile to build an add-on. Science Applications International gapped up but closed at the low of the day. I don't like that pattern. Team, beautiful run up in this quarter. New buy signal came in. I'd like to see it clear the PSAR dots before I go chasing it. Number 8, consumer finance. There are some I like here as well. Visa, big run. Again, this is when you want to buy Visa. You had a big belt hold day here. A new Jeffrey buy signal came in. A Kahuna, a mobile breakout from a squeeze. Now do you want to buy it? Sure, you can buy it up here. It's pulled back some. But I think it's a much more risky buy as your 3 times the growth rate for the PE. Fidelity Information Services. I was looking at this earlier, and I'm trying to convince myself that, there's sort of a in a box here, and it broke out of the box. That's possible. Good earnings per share growth, twice the earnings, and it's on my buy watch because of that. TSS is another one I'm interested in. Why? Because it's based for about 6 weeks. It had my indicator turned positive, a pocket pivot, a kahuna, a mobile breakout from a squeeze in a group with 2/3 of the stocks that are working. What I don't like about it is its earning per share growth, but this one looks like it's going up and it's on my buy list for Monday. So, telecom carriers. I talked about AT&T a few weeks ago. You got to balance the fact that you want to buy these when they're weak, but you don't want to buy them when they keep going down. They have big dividends. In this case, it's 6.4%. It's not a growth story. If I look at the weekly, you could see it's definitely down in its pattern, so it's not expensive for AT&T. I do like the yield, and I'll probably add to a long-term position this week with a buy indicator firing, a pocket pivot, and a mobile breakout. Again, not a growth stock, not buying it because it's breaking out, but I want to buy this when it's cheap and starting to go up and take advantage of a high dividend yield. See if anything else looked interesting here. I think that was the big driver there. And then number 10 is midstream oil, a beneficiary of low interest rates. Cheniere, this says doesn't pay a dividend, so I'd skip it. Here's 1.9, that's not so good. 1 okay, 4.8, 3.9. Now we're talking. Target Resources. So sideways move. Buy signal came in and a pocket pivot and a mobile breakout from a squeeze. Pays 8.8% on dividend. I like that. EQT pays 9.5, down in the lower end of its trading range, but looks like it might be reversing. So why are you buying? Why would I be looking at MLPs? Why are they up here? Because interest rates are low and they pay big dividends. Now, getting a 10% dividend is great, but if your stock drops 25% in the next month, it's going to take you 2.5 years or longer to make up for that loss. So on the weekends, I also do my, I use a medical term, somewhat anal review, where I look at a lot of different groups of stocks from various sources, as well as through HGSI. I run a number of trade station scans. You can see both Q, John Person scans, and I come up with a super list of stocks. And this is what I do on the weekend. During the week, I just do what I showed you, the top-down approach. And that group of stocks is called my consolidated buys. I put a volume and a price filter. And in this case, I got 700. Let me see. Hold on before I open my big mouth. I had 760 stocks that, this is eliminating the ETFs, that met my criteria for purchase and that I went and did analysis on. So I flipped through these charts. Several of them we've already mentioned already. I end up with a buy watch list, which is this list here. Again, many of these stocks we've looked at already, and I look at them for various reasons. You could see biotech was strong, specialty pharma was strong. You could see my AT&T that I mentioned. Internet media was strong. There's my Hoya, IQ, and YY. These are some ones that I thought looked good. Stocks we haven't talked about in a while. Alibaba, which had a big run-up and then stalled. Pull back here right above the 50. And what happened on Friday? There were 8 winners versus 0 losers of new buy signals in this group. 76% are on a current buy signal. So you had a pullback with a Jeffrey buy, a pocket pivot, a kahuna, a mobile breakout from a squeeze. Awesome earnings per share growth. I think it's time to be looking at Alibaba again, so that one made my list. Another one we didn't mention before, JD. Another consumer discretionary looks good. Let's look at Amazon for a second, because you'll notice it's on my list. I have a big holding in Amazon, so I don't normally put it in my list. Why would I be thinking Amazon? Amazon is broken above the 200. It had a buy signal on the daily here. On the weekly a couple weeks ago. But more importantly, it had a new buy signal on the monthly chart. So that makes me pick up my head and pay attention. Another thing about Amazon that I like, the new computer, I always wonder if I'm going to kill it when I open up too many windows. So, how do I put some? All right, that's what I wanted. Now let's look at here. So here's Amazon. Amazon's in a relatively tight channel. It doesn't feel that way. Let me put up my data. This is Seasonality Trader. It's one of the seasonality programs. When it works, it's my favorite of them. Sometimes I wonder if it's still getting all the support, but I'll keep my mouth shut today and be a nice guy. So the data tells me that right now it's got a growth rate of 117% in this channel. Well, that's interesting. It shows me that we're in the bottom of the channel right now, which I always rather buy in the bottom of the channel. This giant green area defines a space between March 22nd and May 6th, when the stock is up 8 out of 10 years, an average of 11.4% on the up years, only down 1.5% on the down years. I like that, don't you? You can see in yellow is the 10-week. Let's see if I can pull out the here's the 5-week, but you can see we've got a positive seasonality here. It looks flat, but look at the numbers. A 10% difference is $180 a share. So seasonality is strong. I go into TradeStation just to show you three markets at the same time. And you can see some short-term ugliness. These red dots would be a reason to watch the stock and not get in it yet. And you could see here a new monthly and a weekly buy signals. And to me, I'm going to have, if I clear this, let me just put my data window up here. If I can clear, we closed at 1780. If I can clear 1792, then I think we'll get to a buy signal. We'll see. We'll certainly go to a green on the chart. So I'm getting it to a point where I might be setting a buy stop at 1795 and taking advantage of the seasonality and the strong chart. Why wouldn't I just go out and buy it? I wouldn't just go out and buy it because right now it's in congestion, and I like to see it break above this congestion, or at least above that number, before I went and chased it. Notice I had a good day on Friday, except I got killed by Restoration Hardware. So Amazon looks interesting right here. Give you a second to take a look at that. I did find some shorts. I'm not buying shorts when I see the market this strong. What I do is I put these together as sort of an early warning group. And if these continue to roll over, I know there's weakness in the market. But typically when the market turns, these groups do very well to the upside. I'd rather buy contra ETFs and puts than short stock if I think the market's going to roll. Right now, I've been undoing those positions. Now, let's just look at Amazon, because you're probably thinking, Jeff, you're telling me to buy it at $17.92. Why would I do that? How can I afford to buy enough Amazon to make any money at $17.92? Okay, I'm going to show you how. So let's open up one of my favorite programs. Options Pro. All right. Now, as I mentioned, every time I do these webinars, I have to dummy down my resolution. So I have to fix windows when I go into new programs. So first thing is, I would be waiting. I wouldn't be buying it today. Optimally, I'd want it to clear 1821. But that's 40 points away from here. So I'm going to be happy if I can clear high here was 1792. All right, so I want it to go above the high on Friday for me to be interested. So I would not buy this stock or buy an option here until I take out that high. You could argue that you've got a bit of a flag here and you want to put trend lines here and buy the breakout of the trend lines. We'll call it 1795 to be clean. Now, I know many of you are, again, thinking, how many of these shares can I actually buy and make money? So I haven't done this in a while, so I'm going to spend a few minutes on this. So let's say I'm bullish on Amazon. So I'm going to look at certain bull spreads to play it. I'm going to look at buying stock, buying a call, shorting a put, bull call, bull put, a synthetic, and let's take a look at what we ended up here. I want to buy starting strike. This could be based on at 1780. You're going to buy yours at 1795. If you're talking about options at the money, it'll probably be a similar price as what we are today. I'll be interested in 2 strikes. So at the money and 1 strike out. I want a minimum move on any spread of, say, Amazon of $40. Why? Because that's 3%, not even. And now let's look at some of the things that we found. Now, before we look at these, let's just start to model. If I was to buy Amazon stock, and those of you that have been to my live meetings know this is kind of how I like to look at things. If I was to buy Amazon stock, hopefully you can agree with me that if I was to buy 100 shares, it can go up, it can go down. My break even is the price I paid for it plus whatever my broker charges were. My break even for up and down is the price I bought the stock for. I can lose 100% of my investment and my gain is infinity. Now, and the problem, I don't think anybody will argue with that. The problem with this is most people, myself included, cannot buy 5 or 10,000 shares of Amazon. And 100 shares is great, but can you do better? You could buy a call. So let's look at a 1780 call, so it'll be a little cheaper. And you're going to see the problem with buying an Amazon call is cheaper is not necessarily the truth. So buying a call, instead of buying the stock where it would cost me $178,000 to control 100 shares, it's going to only cost me $3,942. That's awesome. The advantage of buying the call is I get all the upside. The disadvantage of buying the call is I've got a time limitation. Here's an April expiration. And I have to move the needle from the current price to where the price would be 1820, 1817, 1820. I have to move it $39.42 to break even. So the stock has to go up a lot for me to break even. The best news is my downside risk is limited. So buying a call is less expensive than the stock. I gain the majority of the upside risk, but I also have to deal with the fact I have a time expiration and I have to move the price before I break even. Now, let's say I just want to make some money and I don't want to put a whole lot of risk in. Well, this is risky, but it doesn't cost you any money. Why don't I just sell a put? So I could, theoretically, just sell a put. So let's compare this to buying a call, and you'll see what, hopefully we'll see sort of the pros and the cons of this trade. If I sell a put, I'm selling you the right but not the obligation to sell me the stock at the agreed on price. Now to give you that right, you're paying me $34.65 a share. That means the stock can drop from today's price all the way, I've got the wrong axis working here. But what it tells me is the stock can drop $34.65 down to $17.42 and change before I lose money on this trade. If the stock goes up, the most I can make is the money I collected. My risk is the entire investment as if I bought the stock long, minus the money I got up front. So shorting a put, you've got to be really comfortable that the market's going higher. You have to have a big margin account. I don't love it because you've capped your gains, but I know a lot of people do like it because you put money in your pocket. Now, another way of playing this would be a spread. So if I look at the long call, the problem with that long call was it's expensive. So let's say that my target is 1850. So let's go back to a bull call spread, make the same strike price as this one, 1780. That's not what I want, so I'm going to play with it here and adjust it. I'm going to, this is a bull put spread. I don't want that. Hold on. I'm sorry. I called the wrong one up here. Bull call spread at, that's what I want. So here what I've done in a bull call spread, I've bought that 1780 call, but I said my target's 1850, so why should I be carrying any of the risk above 1850? So what I was able to do is buy that 1780 call for that $39 that I bought here, but then I sold, and let's make that an 1850. So I've sold an 1850 call. All right, so now what happens? I've capped my gain. My maximum risk is less because my cost of play is. So I've given up my gains above 1850. I've lowered my break even from 1819 to 1806. I've reduced my investment from 3942 to 2677. So buying a call spread helps me by still giving me much of the upside, although I'm having to cap it, and it reduces my cost of entry, and ultimately, because that is the money that's at risk if I'm wrong, it reduces the amount I can lose on the trade. If I'm concerned on the put spread of my big risk, on the put rather, I could also do a put spread. So what I've done here is graphed out a put spread. Now in this put spread, it looks a lot like the call spread, where if the stock goes up, I make money. If the stock goes down, I lose money. Because I've sold a put, but then bought one to protect myself, my maximum risk here is 25.30, so it's less than the call spread. My maximum profits is 14.70, which is less than the call spread. But I get a check for 14.70 to take the trade. I don't have to put any money out of the pocket. There's a lot of rich people who take the high probability trade of a bull put spread or shorting puts all day long and putting money in their pocket. Now, those that have been to my meetings know that's not the trade I'm going to take. If I'm going to trade Amazon, I'm going to look at a synthetic. So a synthetic would say the current price is about $17.80. So in a synthetic, what I want to do is I want to get as close to duplicating the curve of a long stock without carrying on all the risk. So on the left here, I have long stock. On the right, I have a synthetic stock. On the synthetic stock, I'm buying a call at the strike price. I'm selling a put at the same strike price. If you look at the P&L curve, they're exactly the same. What is the big difference? The big difference is where my out-of-pocket on buying the stock was $178,000 for 100 shares. On the synthetic, my out-of-pocket is $365 per 100 shares. My break-even, because I'm buying the spread, requires the stock to move $3.65. But I capture all the gains and assume all the loss of owning the stock. That's how I typically play these expensive stocks, because I get all the benefits at a lot lower out-of-pocket. Now, it does require a significant margin account. Now, sometimes I'm a little chicken. So I have the Scott chicken shit spread. And in this one, I would say I like this a lot. But I want to add an option leg. And I'm going to buy $17.30 put. So now what have I done? It's going to cost me $2,162 to buy this spread versus $178,000 to control the same number of shares. I get all the upside of owning the stock. It's going to have to move from 1780 to 1801 for me to break even. But by buying that put underneath, I'm limiting my loss Now, the other thing that happens is I'm not just limiting my loss, I'm limiting the impact on my margin account. So I call this a Jeffrey synthetic or a Jeffrey chicken shit synthetic. And basically, I'm marrying a long call with a bullish put spread. So here's a way that I'm going to look to add to my Amazon position on an inexpensive way with a controlled risk. Now, the other thing that I could do is say, this is a trade, not marriage. So I could come in here and say, I'm going to add another option leg. And that option is going to be buying a call, selling a call at 1850, which was my target price. So now that I'm capping my gains. I'm lowering my cost of entree. My maximum profits are limited, are $6,000 for an investment of $900. The most I can lose is $58.97. So I'm controlling my risk, and I'm looking for a quick pop over the next 3 weeks to make $6,000 on an investment of $897. So the benefit here is I'm giving up some upside, but I'm paying much of the cost of the instrument by selling an out-of-the-money call. So on that note, I think I'm going to say goodbye. My expectations is that we have a strong week. I'm going to show you one more thing, and then I'll say goodbye. So let me open up my Seasonality Now workspace. So this is a seasonality done within EdgeRater, and I like doing it this way because it gives me a quick view of the market. So I run it once, which will be the historical performance on the left, and then I run it again, limiting 1 month, more than 8 years up, no more than 3 years down. And then I start to look at things that have zeros over here and good returns. Now, I've got, for example, Pilgrim's Pride is up 12 out of 15 years, 17% return. LRN, this is probably the interesting one, has been up 11 out of 11 years over the next 4 weeks with an average return of 11%. So I might go into here, LRN. I got the green box, March 19th to May 1st, 9 out of 10 years, 11.6% return. That might be something of interest that I might want to look at. If I'm concerned about a bearish market, I can run the opposite. And notice what do we have here? I ran the same, this is the stocks I run, the entire market. All the contra ETFs. If I have the VIX is down 8 out of 8 years, the TZA is down 80% of the time. The Qs are down 9 out of 12 years. The S&P is down 11 out of 12 years. What does this tell you about seasonality over the next month? It tells me that the market's supposed to be strong. So last thing I want to do is just take a look at that LRN, because it's not on my watch list. I didn't do all my workup yet. Still Saturday, well, it's now Sunday morning. Just type in LRN. Yeah, it's a nice stair-step move. It's got a buy signal came in this week. It's in a squeeze. It had a pocket pivot. 70% in this industry are up. Don't love the earnings per share growth, but this looks interesting. The volume's a little light, which is why it didn't show up in my other analysis. Now I want to go back to Amazon because one of the things that people ask me is, show me how you set up the trade. So I showed you the various trades I could take. I typically would look at something like this and say, first question is, when do I want to get in? And I think there's a couple of potential answers. One answer would be just draw, that's not the trend line I want to draw. Why is that doing that? I could say I've got a flag. It's not really a flag, but it's had a big move. So I'd want to get above that's where I want to do that wrong. So I want to get above this point. All right. High of this bar was 1792. So I'm going to put my buy $17.95 buy. Now, and then I would look at the lowest bar in the last four. And it looks like somewhere in this area, low here is 1776, 1745. So I'm going to put my stop at the lowest bar in the last 4 days, which we decided was at 1745. That's how I would enter that trade. You notice here is the chandelier. I would put a hard stop when I make the buy because I don't want this stock to go down here to 1584. I can stomach this. I'm not sure everybody else can. So I'm going to put a hard stop there. Now, what is my target? My target has to be at least 1-to-1, which would be an 1845, 1850 target in the short term. So what does that all mean to me? It means I would put an order to buy at 1795 when it takes 1795 out. I'd immediately put on a stop at 1745. I would take half of my position off at 1850. I will then let my stop trail with the chandelier stop, and the day it closes below the chandelier stop, I would put a sell order in if it should trade below the low of that day on the next day. I like staying in things a long time. I think Amazon is a good thing to buy right now. And why do I think it's a good thing to buy? Because this is the season of Amazon. On that note, I hope you enjoyed this. I appreciate the comments. Please subscribe and hit like on the YouTube channel. And we'll see you in 1 week. If the market has done what I thought and no changes, then I'll skip next week. Goodbye, everybody.